As you know, yesterday the tariffs were the main news, and people panicked, and you started hearing calls for the end of the bull market. You have been hearing that anyway, but I think we bottomed yesterday. We rallied off that bottom, came back, towards the end of the day. Open today, up a little bit, and I think we're kind of bouncing around here, but I think we probably saw the bottom. The S&P came down right down to the 200-day moving average. NASDAQ slightly went through its, I think, 200-day. But what you're seeing here, I think, is the classic case of the market needing a rest. Came into this year pretty elevated. Rallied a bit from there to new highs, and in the last month, most of February, I was saying it looks like there's some work to be done before we move higher, and that's exactly what I think we've seen. We had basically a 6% correction in the S&P. I'm not sure what the number was on the NASDAQ, but probably close to a 10% correction. And the Russell, which has lagged, got hit pretty hard, but it's fine too. The Dow got hit some. They all came down to levels I kind of expected. The SP went a little farther than I expected, but like I said, down to the 200-day. It looks to me like it's basically we're about to begin the final leg of this, as you say, 42. I think it'll end up being a 43-year secular bull market. Started in August of 1982. Dow back then was, I think, 780 at the bottom. So, the Dow yesterday got down to 42,400. It shows you how far we've come. And I think this last leg is going to be steeper than any of them we've seen so far. You tend to steepen as you move into the top. This is a huge top. Again, I've been at this for 51 years. I'm talking about a top of a market that for most of that 51 years, 42, 43 of them has been a bull market, secular bull market. That's about to end. That's a huge deal, and I don't think people are really recognizing that. And of course, lots of people are trying to call a top here. They fought this market from October of 2022 on up, and kind of capitulated, finally jumped in on the bull side in the last 4, 5, 6 months, and then all of a sudden saw this thing start to roll over and got nervous again. It's amazing. I saw a sentiment indicator this morning that shows we're basically at the highs of bearish sentiment that we've been at over many years. So back to the levels of October 2022 or October 23, even back to the 2020 levels. To have a 6% correction in the S&P that gets people that nervous and that bearish is a huge statement, and it really supports my view that we're about to move into what I call a parabolic final stage. That means you can cover an amazing amount of ground in just a few months. So from here, the S&P, my target is 7,500. That's 30% from here. Or thereabouts. The Dow, same thing, 55,000, about 30% up. The NASDAQ, 40%. And, my target there is 25,000. And my target on the Russell, which is the laggard, I think we're about to see that gain more speed. And you could see as much as a 60% appreciation. My target is 3,300, and that's basically 60% from yesterday's lows. Last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now, 32 and a half, let's say, on its way to, I think next up is 36. After that, probably the mid 40s. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year. flat to down. Yeah, probably flat to down a little bit. And the miners have been big laggards. So that frustrates investors. But again, it's kind of good timing today because I really think we are seeing the turnaround in both the metals and the miners, and that we basically bottomed out yesterday. So I do think, and by the way, gold has done obviously much better than that. Gold's at all-time highs, or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. But for now, comfortable with 3,400. It's still $500 away, and it's had a nice run. I mean, it's moved up from, broke out at 2,100 a year ago or whenever, and you've had pretty much a steady gain all year, all the past year. And so I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here. Yeah, what I think we have, a global bust, as I define it, is something worse than what we've seen in post-World War II era. So in the last 80 years, it's not a depression. It's not going to last a decade. It's something that will be concentrated in a 12 to 18 month time frame. But it'll be worse than a typical recession, and will come with a financial crisis that could be the worst in history, but certainly, comparable to 2008-9, and I think worse, is why I'm calling it a bust, meaning bank failures all around the world. We cleaned up our act some in the banking area in 2008-9. I don't know. We're probably going to be better off than some of the rest of the world banking-wise, but it's going to be a big enough unwind around the world that it'll hit our backs very hard too. So that's coming. I think it probably starts sometime, maybe fourth quarter this year, maybe sooner, maybe later, but somewhere in there. And as I said, we'll be moving towards a bust in terms of recession before that. If I were guessing, I'd say the top is by this summer in the stock market, but I don't know that. And what I expect to follow that is the biggest bear market we've had in the post-World War II era. I'm calling for an 80% peak to trough decline in the indexes. And so if you get an 80% decline, or 75, 80, whatever it is, that means you're going to, almost everything in the market's going to get hit across the board. The only asset that I think really will hold up in the bust are treasuries, and treasuries of all maturities, both T-bills as well as long bond, and everything in between. And that's because you have a government guarantee there, and a guarantee from a government that people trust. So around the world, investors will flock to U.S. treasuries, because they don't know where else to go in terms of safety. So I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, while most commodities are rolling over. That you could see a 0% 10-year rate at the bottom of the bust, or at the top of the bond market, and that could be late this year or early, first half of next year sometime. 0% 10-year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bond or a new low in rates. Short rates probably go negative, and the reason for all that is because of they're gonna be slow to catch on and slow to want to do it, because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's, free-falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see the Fed balance sheet increase by $20 trillion. I mean, the Fed balance sheet got to $9 trillion a couple of years ago, last year, I guess. And early last year, and has shrunk down to maybe 7 now. Prior to, when we went into the 2008-9 decline, the Fed balance sheet was $875 billion. So we're now up to, got up to $9 trillion. I'm saying in this reaction to a bust, we could see $30 trillion in the balance sheet. an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking system free falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. But that's kind of what I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, but not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, 3,500, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and they're not as big as the equity markets, but still big. Still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver and gold, on the other hand, silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof, simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s and 2030s. So, it's a very extreme forecast, but we're nearing the end of a super cycle that's been in existence since the Great Depression, and that's what happens at the end of super cycles, is everything goes to extremes. So I think that's where we're headed.